for all of you as a big picture, whether you're a small business owner or have like executive with stock comp or you're a newly minted retiree, the question ultimately is my cash flow going to change substantially?
Scott, happy 2026. Welcome.
Right back at you, man. So this is going to come out a little after recording it, but we just helped a lot of clients ask and answer the question, did I pay the appropriate amount in taxes to not have to pay penalties?
Why is it so hard? Like
because it is hard.
And not on the client side, but like it's so nebulous at times where you're like, hey, did I pay enough? Well, how much did you make last year? And it's like this mystery box, and it's a hard question.
So my thought is let's just spend a little bit of time helping all the listeners understand, like, why even worry about how much tax did I pay and what happens if you don't, and how can you figure out what you should pay? And there's kind of different answers dependent on different situations.
Totally. I like to approach this from like two sides, like, hey, let's clean up 2025. Let's figure out that question. Did I pay enough? And then going into 2026, blank calendar. How do I put together a system so that I know that we're paying enough for the entire year? And what are the checks and balances along the way to make sure we're staying on track?
Yeah, absolutely. And the listeners I'm more specifically thinking of, like, if you have a salaried job where you just get paid a salary and nothing else, probably not a huge issue, but it could still be an issue. We can talk about how to fix it briefly. If you get stock compensation where you have restricted stock units or you have options that you're exercising, bigger issue. And then if you get paid bonus income as well, also a bigger issue. I'm also thinking of the small business owners who you actually have no one telling you how much money to put away anytime. And you have to kind of deal with this. So how do you kind of put in place a system to help you be okay and check it?
Right.
I think finally we could also touch on just those newly minted retirees. Like, as you have things click in your life where, like, maybe you think like, I don't ever have to worry about taxes again. I don't really make any income. Not necessarily. The moment we start taking required minimum distributions, or we sell a house, or we turn on Social Security, or a pension kicks in, all of a sudden we have these new income sources where you might need to think about withholding some taxes.
Absolutely. Yeah. I think of so many things around retirees on, getting an inheritance or where that first dollar comes from, or, wow, well, my income looks different than it did last year. How do I adjust? And, for the W-2 folks too, if you have big life events, maybe you got married, something we could think about of, well, the IRS, those paychecks don't talk to each other on how much to withhold. So how do we set in place a system to make sure we're withholding for both folks now? So yeah, a lot of different moving pieces, but yeah, let's start to break that down.
Yeah, so let's just talk about it. The biggest basic view to have, and most and states apply this similarly to the federal government. So we're going to focus more on the federal government with a caveat here and there. This is a system that is pay taxes as you go. So you don't get to, make $1 million and then not send anything in and then owe them $300,000 on April 15th and send it to them. And they're like, good job, Nick. They want to see Nick, if he makes $250,000 a quarter, send in estimated payments along the way. So, like, you see this happen commonly through your paycheck is the simplest place. If you do have a salary job, money is taken out every paycheck to go ahead and make sure that money gets to the appropriate government agency, whether it's the IRS or here in California, the Franchise Tax Board, to make sure that you're putting in the proper amounts along the year. At the end of the year, when you do your taxes, you're going to see, hey, you owe a little bit more or a little bit less. And then sometimes you miss something like, oh man, I had all this RSU income, and RSUs get withheld at 22%, but I'm in a 37% tax bracket. So I really owed an extra, 15 grand on every 100 grand of income, and I had $500,000 of those. Well, man, you owe a lot more taxes now, right? And you didn't know that. So then you get this tax bomb dropped on you at tax time with your accountant, and you're upset. You don't know what to do. What we're going to focus on today is you can do projections to see what do you owe, but more so than that, we're just going to talk about this idea of safe harbor.
I like the idea of safe harbor. It can be a scary word, or just like, oh, what does it even mean? But the government designed it in this way to help make the guessing a little more simple. right? So, with the pay-as-you-go system for W-2, pretty easy. But all these other
Mm-hmm.
circumstances or situations that we described, well, it gets a little cloudy. And so they made this rule known as safe harbor, which is like, think of it almost like a safety zone where the government promises, right, not to charge you extra fees or penalties if you get it wrong. They say, so long as you hit
Mm-hmm.
this number, this lower boundary or threshold, you're going to be okay. And so the deal is if you pay at least as much as you paid last year, you're okay. Even if you end up making more money along the way, you've at least hit that first threshold. Or the other idea is if you pay 90% of what you actually owe this year up until a certain amount, you're actually safe, right? And so I like to think about it as like,
Yep.
hey, we'll say we owe $100,000 in taxes. Well, if you pay at least $100,000 in taxes over those 4 payments, they separate them up, right? The government says you're okay. Like, we won't actually charge you more, even if you actually ended up making more and you owe 200,000. Just pay the extra $100,000 later with no penalty.
Exactly. So safe harbor normally is, just to recap what Nick has said, you're going to have a safe harbor amount. You're basically going to go say, hey, what did I pay last year in taxes? And so long as I make under 150,000 if I filed jointly, or 75,000 if I'm single, I can put away 100% of what I paid last year, and I'm
Yep.
safe harbored. I can also, if I make over $150,000 a year, I can put away 110% of what I made
Yep.
last
No,
year, and I'm safe harbored again. And then if I don't know, maybe it's my first year ever making money, I can put away 90% of what I think I owe this year, and I will be safe
yeah.
harbored. So there's kind of 3 different flags to measure yourself by, depending on the
Yeah.
situation.
And I look at this as just a good baseline. Like, pick one of those. You're going to be okay. And then you can adjust and back into it. But at least we're not going to owe any penalties if we hit one of those thresholds. And that's a good starting place.
Exactly. And then it's like, well, why do this? What am I avoiding? So you're avoiding penalties and interests, essentially, if you didn't pay on time. And the basic kind of rule of thumb for like failure to pay is about 0.5% of unpaid tax for each month for however long it's late, and that gets capped at 25%. But then you also get to pay interest on top of that, whatever the interest rate is that the government has set. They're basically saying like, hey, Nick, you basically took a loan from us by not paying us taxes along the way. So we're going to make you pay us for that loan. That's basically what's
Whereas if we
happening.
just did one of those benchmarks from our safe harbor, we will have been depositing money along the way, satisfying that pay-as-you-go requirement. And so it's like,
Yeah.
and I've seen this in times where clients make a whole lot more money in 1 year. Maybe they get a promotion, they sell a business, whatever happens. And they look at it and they go, oh my goodness, I owe all this. And I go, well, have you been making the quarterly payments at least? Oh no, I didn't realize I had to pay those. I thought I could just do it at the end. It's like, no. Now we got to calculate under withholding and penalties and those types of things. And so this is a great foolproof way, at least just to get you to the threshold without getting penalized, right?
Absolutely. And so basically, like, let's start at the baseline. You have a salary. If you owe taxes every year just based on your salary, there's this form called a W-4 form where you can say, hey, I want to withhold more taxes throughout the year so I don't have this surprise at the end of the year. That's the first thing that you can do. And if you just have simple salaried income, that's probably the best thing you can do. Now, the next thing that we commonly see is people will come into our office and they'll be like, oh, I had this $80,000 surprise tax bill last year. And then you're just like, well, tell me about your income. And you're like, well, I make a salary. We both make a salary. We both get bonuses, X percentage of our salaries, and we both have restricted stock units. And then I just go, well, cool. Tell me how you treat your restricted stock units and your bonuses. Well, the bonuses we just let flow into the bank. And man, they take so much out when that happens. That's normally the conversation. And then the restricted stock units, we've just been letting them grow and vest in our stock compensation plans at work. And I'm like, lovely. Most people don't recognize that, like, Your stock of 100 shares, the moment that you receive it, is considered income on your tax return.
Right.
But the federal government has a rule that they're going to withhold 22% for federal government, and then the state will normally do their proper state amount. States usually aren't a big issue. But the problem is that you're not in a 22% tax bracket. You as a couple are in a 37% tax
There's
bracket.
your issue.
So you owe 15% more on all of that income. And that's exactly where that surprise came from. But you didn't sell the funds and you just didn't know about it. So it's just clarity to help you with that. Now, there's two things you can do there. If you turn that money into cash, you can, of course, set funds aside and send estimated payments. So I should say there's three things, because that's the first thing you can do, simplest. The next thing you can do that's also lovely is you just go, oh, I'm in a 37% tax bracket and my stock compensation portal will let me set the withholding from 22% to 37%. Well, now you're done. Like, it's going to do it for you automatically. And then the final thing that you can do, I just forgot. What is it? There is a third thing. It will come back to me.
Yep. I like to look at too, whether it's small business owners or in the case of even W-2 employees, if we're already making quarterly payments, maybe that's just easier for us. That's how our operating system works, our household finances, where we're at least paying it. We have those vouchers, they're due every couple months, and we're paying them based off of what we made last year. Keep in mind, it's based off of what you made last year. It's satisfying that requirement. But if you're now in a situation, and we hope you all are, where your income has grown, your business has done well, maybe you got a promotion, you're still going to owe taxes at the end of this upcoming tax year because, well, you made money. You made more money. And your quarterly tax payments that you paid in were based off of last year. So one of those good things to also just keep in the back of your mind here is, if you're making more money in this current year, you may want to go, whether you're meeting with your accountant, you're looking at what you're paying in and saying, am I paying enough? I know I'm not going to have penalties, but if I'm making more than I did last year, maybe I should be adjusting this so I don't still have a big oops or surprise later on in the year. No penalties, but still surprise.
That's an amazing point. Because to your point, we're talking about putting enough aside to not pay penalties and interest. We're not talking about paying the full bill. So if you do flip, for instance, to RSUs paying 37%, you're probably getting closer to paying the full bill. You're probably not an effective tax rate of 37 because tax rates are progressive. They start at 10, 12, and then go 22, 24, and all the way up. And you pay all these along the way. So even when you cap out at 37, your effective rate doesn't ever get fully to 37. It can't, because you paid all these lower rates along the way. So, but to your point, and the other thing I finally did just remember, the third thing, you can change your W-4 form to withhold more cash from your own paycheck every year, or every, paycheck. So if you don't want to necessarily do that out of RSU income. A lot of this has to do with cash flow planning as well as tax planning. It's, where am I going to get my cash flow sources to live life? And how do we make sure money works really well for us, nice and smooth? And for small business owners, the main thing that I think about for small business owners, we're both small business owners. If you're just a Schedule C, like traditional small business owner who doesn't have an S-Corp election or, isn't paying yourself a salary, you basically on a quarterly basis need to be looking at how much income did I have and make sure that you've set, simplest thing is, with your accountant or with an advisor or on your own, figure out what is the net amount of, for every dollar that comes in, I need to set aside money for Social Security and Medicare and state taxes and local taxes. What's that all add up to? And then on a monthly basis, you want to take that number, and if I receive 10,000 and I need to set aside 25%, I need 2,500 to go into a savings account at my bank that's called taxes. So that every quarter I can go send it to the appropriate places, right? Like, that's the simplest answer. When you do grow enough to have perhaps an S-Corp makes sense. S-Corps used to make sense at very low income thresholds. Now with qualified business income, they usually make sense at higher income thresholds because you have costs associated with running that S-Corp versus being a Schedule C traditional business owner. But once you do that, you can do a lot of withholding through your salary as well. So there's just a kind of a balance to look at for how much tax do I need to withhold, but you do need to pay attention to it. You don't want to just wait until the end of the year.
Yeah. And so as, January is now here, I'm not sure when this podcast episode's going to drop, whether January or February, what kind of things should our listeners be putting into practice? I like looking backwards at last year. Hey, how much do we earn? How much do we end up paying? Right. So knowing our numbers, but then looking at our pay stub if we are W-2 and saying, like you mentioned, do we need to go back to that W-4 and change some things?
Absolutely. So this is exactly, I was thinking about this for a recent client who just had a big sale last year in their company stock. So they're going to have a really big tax year for 2025. When you have a really big tax year that's not normal for you, you don't necessarily want to use the estimated payments that are created off that
Not a
tax
good benchmark,
return,
right?
because you're not going to have that much income again next year, right? So then this year we probably want to do the 90% mark of this
Right.
year's income versus the 110 of last year's. So part of it is just know your
The
situation.
other thing too, and we talk
Right.
about this with clients, is like, know your situation along the way. Go check in June. Go check in September, where you could pull your pay stub. How much have I been withholding? What am I on track for? And am I in the ballpark, in the vicinity? And if not, that's where we make those adjustments there and now rather than in December.
Absolutely. Another little caveat that I just remembered for this particular instance. What we've been talking about for estimated payments so far is, hey, you either get to do 110% of
Right.
income this year of last year's or 90% of this year's if you are, above that 150,000 mark. Well, in California, they have this special rule where if you're a joint filer and you make more than $1 million in a year, you need to pay 90% by the deadline, dead stop. You don't get to choose anymore, right? And then if you make $500,000 and you're single, same thing. So just know that there are specific rules, that we're speaking in some generalities here. And there are specific rules per state and per all those things that you want to go look into with your accountant and your advisor to make sure that you're really taking care of this.
And with the quarterly estimated tax payments, they're kind of wonky if you've never paid them before. Where the
Yeah.
first one is due in April, right? Tax deadline. And then you have June, and all on the 15th, but then, September and then January for the following year, but it's due for quarter 4. And if you're not careful, you could feel like you're paying a lot because no sooner do you get done if you owed for your prior year, do you then on April 15th have your first quarterly payment, and then you would think they'd be spaced out evenly, but then June's just 2 months away and you have it again. And so understanding how do we cash flow this as well and make sure that system's in place.
Oh, absolutely. So it's basically if I were, and then we briefly touched on it, but for retirees, and I think we nailed how to do estimated payments, but just think about for all of you as a big picture, whether you're a small business owner or have like executive with stock comp or you're a newly minted retiree, the question ultimately is my cash flow going to change substantially? The first question is, am I already close? Am I already hitting my safe harbor? That's the first question. If I'm not, I need to fix it. The next question is something going to change for me in my income that makes that the numbers change in a manner I might need to address it?
Yes.
Right? And then once that's set up, then we need to look through the cash flow component to make sure that cash flow is set up to handle it appropriately for you throughout
We
the
just
year.
had an episode on how to automate your finances. Build this in too, right? Don't let taxes be a surprise, and just add this as just another line item. Like you mentioned for the small business owner, just go put it in an account for taxes. You can look at it throughout the year, but it's not yours, right?
Absolutely. Totally agree. All right. Well, I think we beat that one with a dead horse, like a dead horse. However you're supposed to say that. If you guys have questions, feel free to submit, like clicking below. We'd love to hear from you. We want to answer your questions and help you. Both of us, our core focus is kind of helping those who are on their path to retirement and are retired and address the questions that you guys have. And if you have it, someone else wants to know the answer too,
Absolutely.
I promise. So send it in. And until then, have a great
See you
day.
in the next one. See you, Scott.